You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.
Our last panel of the day, we wanted to bookend it and really provide, looking forward, spent a lot of time, touched on many times during the conference, during every conference, talking about education. Want to go down deep on that topic for a little bit right now. Please help me welcome up Alan Grigoletto in the next panel.
Okay. Well, thanks for sticking around.
Yeah.
I think you'll find this next panel very interesting. We have some very knowledgeable folks here. What I'm going to do is, rather than have me introduce them, I'll let them introduce themselves and say a little bit about who they are and their companies. So I'll start off with you, Loren.
I'm Loren Reinhardt from OptionsCity Software. We are a software firm that provides market making and algorithmic trading software to the options community.
Hi, I'm Dan Passarelli. I've been in the business since '93. I was a market maker down on the floor of the CBOE, then joined the CBOE's Options Institute, teaching retail, institutional, and other professional traders. Then ultimately started Market Taker Mentoring, which likewise teaches retail, institutional, and other professional traders.
I'm Michael Khouw. I'm suffering a little bit from allergies here, so apologize for my voice. I also started on the floor as a market maker. I ran a specialist unit on the American Stock Exchange. I also traded natural gas options on the NYMEX. Before moving to the buy side, I worked for a long-short equity hedge fund in Los Angeles. Dash Financial, which is the company I'm currently working with, provides algorithmic trading solutions to institutions. And in 2008, working with CNBC, we started a TV show about options trading called Options Action, which fortunately has been successful enough to stay on the air for the last 5.5 years. And it's been about 1,000 TV appearances. It's hard to believe all that time, but so that's something else I'm doing.
Hi, I'm Mark Skalabrin, founder and CEO of Redline Trading Solutions. Redline provides ultra-low latency market data and execution solutions, equities, options, futures, and foreign exchange. In the options market, we have a broad range of customers. We supply banks who are building smart order routers, algo trading systems, and building solutions to do price improvement on retail flow. We also provide solutions to proprietary traders, and also most recently to small tier market makers who are entering the market.
Hello everybody, thank you for sticking around. I'm Peter Lusk, former market maker. It's kind of fun, I get to see some of the people I traded with on the floor of the CBOE, and I transfer that knowledge into education. I work for the Options Institute, which is the educational arm of the CBOE, and I'm delighted to be here. Thank you for staying.
Well, great. I'm going to just throw this question out. Maybe Mike, you can start it off and pass the ball on. But we've been very fortunate to be in an industry that is growing, and option volumes are headed for year-over-year gains versus last year. All of this, despite the fact that we've had range-bound volatility. Do you believe this is evidence of a wider use of options amongst participants, both institutional, retail, and the like?
Absolutely, I think it is. You know, a lot of times we have people who are comparing the options business to cash equities and some of the asset classes that haven't seen the kind of volume growth that we have. We really have a lot more opportunity, I think, because participation amongst investors in trading derivatives of any kind and listed options specifically was quite light compared to what we see in the equity world. The product, I think, intimidated a lot of folks. There are some people in the room who have written books which help to educate them. And I hope we're doing that as well on CNBC, and obviously the Options Institute is doing a lot in that regard. And it's interesting, I still speak to people every day who don't seem to understand the product all that well, which actually bodes well for us because it's a problem that, once we've identified it, we can look to solve it, and I think you could see participation increase. Obviously, an increase in volatility would help. We saw that in January. You're going to see volumes increase in that case, but that's just among existing users.
Anyone else care to chime in on that?
Yeah, sure. I mean, we definitely see a growth in demand that are coming from different parts of the markets. I mean, most of our customers have been established in the markets, but we see banks who have, previously white labeled their flow, now building their own internal systems to support customers because they see it as a more important part of their business. We see proprietary traders who were classically in the equity space now building options as part of their strategy. So we see a growth in demand, I think partially because of people understanding the flexibility and the different ways options can be used more than they have in the past.
And Peter, I'll throw this out to you. Doug Engman made the comment earlier that one of the positives is that China's going to open up their options exchanges sometime in 2014. I know CBOE has been heavily involved in helping to educate. Can you speak a little bit about what's happening at CBOE Institute and education for some of the Chinese folks?
I thought you were going to ask me to speak the language, and I do know a little bit. I know how to say thank you. It's
Ni
shay
hao.
shay.
Ni hao. Yeah.
So we've actually had 6 groups in the last probably 18 months that have come through Chicago. They view us as pretty much being the pinnacle of options education, and hey, we like to think that too, But what's really important when they come, well, first of all, like Doug said, they're opening up their first options exchange in 2014. And I feel a part of that because of the education that I've done along with Jimmy and Marty and Russell, some of our other instructors at the CBOE. But what we do, we try to teach them not only the materials and how option pricing works, but also how to teach it, how to teach it. They're armed with all of our materials to go back home with, but also the ways that we teach it as far as, expressing what all the Greeks are and how do we do it. We go onto a pricing calculator just to lock it all in. So we're giving them just thoughts on how to express their teachings for their educational purposes that they're going to really have a challenge with, that's for sure. But we've got another group coming in, Alan, in June for 2 weeks, so we're delighted.
Just nonstop,
just keeps
continuing to educate them. And of course, it's such a big market and could have a huge impact for our markets in the future. Let me ask a good global question. So have we accomplished what we set out to do with education? Is it still necessary today? I mean, obviously we have broker-dealers doing education, OIC does education, CBOE Institute does education. Is it still needed as much as it was, 10, 15 years ago?
Oh, man. Well, go ahead.
You can start. Go ahead.
You know what? I heard a number tossed around the other day that only 5% of investors trade options. And to me, that sounds like about a correct number. So I think, you talk about options education being necessary. Yeah, even more so today. This business, I mean, I remember growing up, my parents always said, you got to get into a growth business. Well, I'm in one. And right now, I think the sky's the limit, not only for China, but right here. I mean, this business to me is still untapped.
And Loren, you have a lot of diversity of clients. Can you speak to that as well?
Sure. I think it's a very important part as it relates to the technology aspect of the industry. Talking about things like latency, various things related to technology are an important part of education and understanding as this gets more and more electronic. We talk about algorithmic trading. What exactly does that mean? Automation, all of those different things are certainly an important part of education, and we do a number of different things. From the software side, whether it be webinars. We also do a University of Chicago Midwest trading kind of competition that involves undergraduates that are either kind of programmers or econ finance majors. We also do our algo trading conference every year, which kind of tries to blend the trading side of things with the programming side of things. So, yeah, it's a very important part, especially as it relates to the technological side of the business, for sure.
So it's not just driving education for education's sake. It's education really to help your own business models grow, in fact.
Absolutely.
And Dan, you're doing a lot of education as well. You're doing a lot of mentoring. Can you speak to the interest in education?
Yeah, sure. I mean, I started teaching options in 2005, and I mean, the interest has just grown and grown and grown. Peter had an interesting statistic that 5% of what is the accounts are people who are trading options, right? But to couple that with another statistic is pretty interesting. There's right now the notional value in the options market is $4.8 trillion. So that's about 25% of the U.S. equity market. So people are using options and using them very, very competently, and there's so much room for growth because only 5% of people are actually using options right now, and the sky's the limit. I mean, we have a really untapped resource of investors who can use a very, very useful product.
One thing I'd like to throw out there as far as education is concerned, it's really important that we educate investors because we want them to have a good experience with the business that we're all in. For self-directed accounts, I think they trade approximately 20 times as frequently as equity-only accounts do. They tend to be larger accounts as well. But one of the things I'd really like to see us do is not just focus on those individuals, but just about the product in general and how it can enhance risk-adjusted returns when it's properly applied. I think the CBOE has done a decent job of just talking about some of the basic strategies, such as naked put writing and covered calls, reducing the volatility of portfolios and still maintaining relatively comparable levels of returns. But there's a lot of other strategies that can be employed to create levels of volatility that are more consistent with fixed income portfolios, but with much higher rates of return. And I think if pensions, for example, where we need to see probably some adjustments in some of the regulations there, but we need to educate people so that those that would probably like to use a product but can't will start to.
Do you agree? Where should we be concentrating our resources on education? Anyone? Which entity? The institutional space, the wealth advisor space, other? Where should we be concentrating our real educational resources? Where's the growth in the U.S.?
First of all, I would say all of the above, but I think the focus might need to be on the advisors. They've got a good understanding of what their clients are holding. If we can get to them more, we can help them help their clients. That would be my comment.
Yeah, I mean, I'd agree with Peter. Yeah, the answer is which one? Yes. Everyone. But, I mean, the advisors are a really, really useful group to educate because they have many investors effectively beneath them that they represent. But they also want an educated consumer themselves. So educating the individual, be it a retail trader or an institutional trader, that's ultimately what's driving growth for everybody in this business.
And Loren, you're in the institutional space. Are you seeing tremendous growth in the institutional space? I mean, that's probably the biggest piece of the pie, I think, in terms of where we can grow the business.
Yeah, absolutely. I mean, I think you've seen certainly kind of more diverse audience in the institutional space, whether it be prop trading firms, obviously the market making firms, banks, hedge funds now have more of an interest in options, and we've seen kind of a matriculation into more diversity as it relates to kind of even the options on futures side of the business as well. So you've seen kind of a transition. I think part of that is related to the spreads getting very narrow on the equity side, whereas there's still a spread in some of the options on futures. We've seen, kind of a transition or, a further interest in that side of the business as well. So, and that's across kind of all these different institutions. So, and those guys are always interested in further education as it relates to, again, latency, more algorithmic trading, automation. I mean, I think those are kind of the things that continue to develop and change more dynamically and require a kind of a constant update and refresher on those kind of changes in the industry.
You mentioned latency. Does the user really understand latency or transparency in our market? Mark, is latency well understood by your client base?
I think there's a lot of confusion in the space, particularly in the options market. I think it's well understood in the equity market what you need to do to get good performance, but people are struggling right now in the options market to understand the dynamics of latency. Most systems, many systems still trade off Opera today. There is a huge latency difference between Opera and the direct feeds, milliseconds to hundreds of milliseconds. And people are struggling to understand this both in terms of, well, yes, you can be faster, but what is the business impact of that? How do I make money with that? Which applications need that, which don't? So there's a lot of confusion in that space. And then you marry that to the price structure where there's a 10, 20, 30 times more expensive to gear yourself up with direct feeds because of exchange fees and infrastructure costs. It's a complex formula for people to figure out, how do I really build a profitable new business? There was some talk earlier about, not seeing small market makers come into the space. Well, when there's this $500,000 to $1 million you have to pay to get started, it's a difficult barrier to build a competitive business.
And Mike, do you agree with that? I know you had some opinions on transparency and latency as well.
Yeah, I think, well, I'd probably separate the two issues, I think. One of the advantages that we have in the options market is that I think we are relatively transparent because we trade everything ultimately in a lit market. I think that's a benefit. I think increasingly people are sort of becoming aware of the microstructure of the market and how that might affect them in terms of performance. So latency certainly is one way you can be impacted. How routers actually function based on trying to navigate that labyrinth of of whether it's preferencing, whether it is related to the maker-taker fees, and whether you're trying to go to exchanges that aren't going to charge you, or if you're trying to go to inverted exchanges in situations where you might possibly get paid. There's a lot of mechanisms that can ultimately impact things like yield. I don't think that's really an impact so much for retail investors. Retail investors are, I think, exceptionally fortunate. I think one of the unfortunate things that did come out of Michael Lewis's book is this rigged market perception. Most of us in the room started in the business when it was obviously a lot worse for retail investors. The cost of transacting was greater, the spreads were much greater, the liquidity was lower, the amount of time it took to execute was much longer. Every one of these things has improved by orders of magnitude. And now as we sit here and we talk about how transparent the market can be, there's always places to improve, but I think we're probably in the fairest market, certainly in my lifetime.
But there's an education piece of making people know that. So, I mean, there's a lot of good things in the options market, price improvement auctions, for instance, that there's a big benefit to the retail client. And the market maker structure, I think, one of the reasons you don't see negative high-frequency trading is because of all the positive high-frequency trading, which is market makers, really a well-structured market maker system, and the markets are extremely efficient. It's very difficult for someone to come in with a strategy and make money because the markets are already so efficient.
Do you believe that we should, as the poll was taken earlier by the panel of our experts, do you believe that education should be concentrating its effort with regulators and talking about the plumbing of the market as much as we go about teaching the theoreticals of the market? Should we spend as much time as an industry doing that?
Well, anybody who's had to, have a conversation with regulators in the industry realizes that, the level of understanding isn't always ideal. How could it be? This is what we live and breathe. So we would obviously understand it a little bit better, and I think it would do us all a lot of good if we educated the regulators a little bit better. Legislators too, of course. The problem is there that every couple of years we get new ones, and so it makes it kind of a continuous process and a fairly frustrating one. You probably know that better than anybody. Think of it.
So the options industry is very innovative. I think we'd have to pat ourselves on the back in that fact. I mean, compared to a cash market or futures market, we tend to innovate and innovate very quickly. We tend to bring out new products. We're constantly appealing to the users who want more product or more defined product. We've seen good growth in the weeklies. Do we perceive that that's going to be the path of more and more weeklies, and we're going to move the term structure more forward because that seems to be very appealing? Or do we continue to innovate other products? What's missing? I guess that's the question, is what is missing in the marketplace that we haven't addressed?
If I may, I don't want to dominate the conversation too much. I think the innovation that we're seeing is probably not so much in the products themselves. I mean, we now have tight strikes, a lot of tenors. You can trade flexes. Weeklies are obviously quite active. But I think where the innovation is going to be seen is in the technology that helps people decide in that vast array of options which ones they should be trading, what kind of structures they should employ, how many of them they should be purchasing or selling if they're hedging a portfolio. Essentially, how to optimize their trading strategies. And I think we are seeing that type of innovation. I mean, if anyone went around the exhibit hall, I think the guys at TradeLegs, for example, are doing some very interesting things. And there are many others. I'm not trying to single them out necessarily, but I think that's probably one of the more important areas of innovation for educating consumers of the options product on how to use them.
And that's a good segue to you, Peter. TradeLegs, can you tell us a little bit about it?
Yeah, that's really a neat product. Take your institutional investor. He has an opinion on the underlying, but yet he doesn't quite know what to choose for a strategy. So I think you were impressed with the platform as well as others as well, but I spent about a half hour with these guys, and it was really cool because we put in our estimate of where we thought this underlying was going to go, and within about 3 or 4 seconds it comes up with the best strategy based upon our opinion. And they liken it to finding a grain of sand in 400 million beaches? At least that was the pitch that I got.
10 to the 30. So
10 to the 30.
The ideal grain of sand, Peter Hauser is over there, I think, but the ideal grain of sand on 400 billion Earths.
There it is. Okay.
So to find it on a beach, all the beaches, 400 billion Earths.
That's
a lot of possibility.
And the real challenge for any kind of a trader is really choosing strike prices, choosing how far out in time do I want to go, right? So that TradeLegs is taking care of that end of it to a certain degree. So yeah, pretty impressive platform.
And you've got an educational front. CBOE just recently did a major app and a revamping of your educational facility.
Yeah, well, the app is coming out this year, and it's going to have a really strong focus on option pricing, which is really the whole game, right? At least for me, anyway, still being a retail trader now as opposed to a market maker. So we're excited about the app. We're excited about our new website, which is going to have a really strong focus on volatility. And as far as our facilities, it's really awesome. We've got this brand new facility in Chicago that you need to come and see. It houses about 110 people in our auditorium, and it overlooks the trading floor. So when we have the Chinese come in, or we have any of you come in for any type of education, what better place to learn than looking out over the trading floor? It's kind of like surfing. You know, you're not going to learn how to surf in a cornfield. You want to surf, you want to learn right on the beach, right? Where you got this, you know, very engaging area overlooking the VIX pit, the SPX, and just the folks that come in to learn, they really get off on that, and then I get off on it because I'm so excited to teach them because they're excited. So yeah, we're really thrilled with the facilities. It's really functional, and I hope, you know, I'll even put a little invite out there. If you guys come through Chicago, I'd be glad to show you not only the facility, but we'll take you down. We'll look at the VIX pit or the SPX. So we're really thrilled about the whole thing. Thanks for asking.
And what are the strategies that you're seeing have the most interest? I mean, we're getting very, very complicated now in the educational process. You know, you used to just teach a vertical spread or the like, and now it seems that the appetite is getting more complex spreads as the prices have gone down. Maybe Dan, you could address that.
Sure. When I started working with retail traders, I was teaching strategies like covered calls and collars and, you know, cash secured puts and such. And then it sort of slowly started ramping up, and now I have people who call me up on a regular basis wanting to learn reasonably complex, you know, VIX versus VXX type strategies and spreads of that nature. So, I mean, I think that as this industry has grown and as the innovation that we talked about with new products that are coming out, be it volatility products, weeklies and that sort of thing, the end user is responding by getting himself more educated and learning more about these products and ultimately trading in a much more sophisticated way than I saw just, 8 years ago.
Yeah, Alan, the weeklies are huge, you know, and as an educator, we like to take these retail investors from, say, a traditional covered call, because these weeklies are suited for short-term strategies. And hey, how about banging out a weekly call each week? And by taking advantage of that time decay, yeah, the weeklies are going to outperform the traditional monthly. So yeah, it's a big part of our business, and especially a big part of our business when we're talking about an earnings period, for sure.
I heard earlier in the conference that, you know, the weeklies, I remember when the weeklies were first launched, and the industry looked at it as purely a retail product. They didn't look at it as anything other than a retail product. Now, we were hearing earlier in the conference that it became a good institutional product. Why?
Well, I mean, if it's a good product for a retail trader, it could be a good product for an institutional trader. It simply has advantages over its own competition. You know, weekly options, of course, have greater theta for option sellers, and, you know, greater gamma and lower cost for option buyers. And I mean, that's good for anybody who's using it. On a large scale, somebody trading, you know, 1,000 lots at a crack to hedge something, or a retail trader who's trading onesies and twosies.
I mean, I think, you know, Peter touched on a good point as well. It's a great product for earnings events or various economic, you know, events. Additionally, it's a short-term product, and you know, the trading community likes that time horizon, I think, and you know, there's a lot of liquidity there, so absolutely they're going to be participating in it.
And we've seen a lot of volatility products be launched. Obviously, CBOE brought out their newer volatility product. ISE has a volatility product coming out. Is that the future, more in that genre of the space? Not an easy concept for the average person to comprehend, right? Can you address that? Is that where the growth is in the industry and the volatility? And what should we be doing on the educational front to bring those investors along on understanding implied volatility?
Well, currently it's real evident, and our numbers came out yesterday about our products. And once again, I mean, the VIX trades up a storm, basically. And we see institutional investors that are just thrilled to not only do directional trading with VIX, but also for portfolio protection. And yeah, you're right, we just came out with a short-term VIX, which is a 9-day forward-looking model. That's VXST. And yeah, we're really excited about that product as well. So that's continuing to grow.
Yeah, I mean, I think it's a great product to be able to, you know, a retail or you know, individual investor to hedge their portfolio. Absolutely. I mean, there's a lot of utility in that, and you know, I think the retail community is certainly starting to pick up and understand that it is a helpful product, and I think there's going to be more interest in those types of products. Absolutely. I mean, you see all these kind of ETFs associated with the VIX, or the ETNs that are coming out associated with the VIX products. So yeah, I think you're going to continue to see more interest and more innovation as it relates to volatility-focused products, for sure. I think,
you know, we were discussing this backstage, is that you're now seeing a lot of innovative ETF products, 40 Acts, sub-advisors servicing the option space are coming up with new product offerings that can only help to grow the industry. I'll ask you, is too much product too confusing? I mean, we got a very packed shelf full of products out there. Is it too confusing for investors? And what should we be doing about that?
I think that, well, there's obviously a lot of choices, when we put it that way, that can be a little bit overwhelming at times. I think the appeal of the volatility products, though, is that it is a way to get exposure that doesn't involve, you know, some of the complexity that might be involved if you were going to try to do that synthetically. So if you wanted to have, you know, the anti-correlation benefits that volatility products tend to exhibit against most long portfolios, you know, some of these products are going to create, you know, the easiest possible way, I think, for you know, novices in the space to get that type of exposure. I think ultimately, though, as education improves, as tools to help identify the ideal structure using, for example, listed options, people are going to be able to trade that. And I will tell you that one of the things we have seen is some very sophisticated trades being conducted in the markets electronically. An example would be people that are doing variance replication or synthetic variance trades electronically. You know, I noticed a couple trades hit the tape in SPY, for example, that would have been almost unimaginable many years ago, because you couldn't have done it. There weren't as many strikes anyway. But 80 leg trades, and you know, we modeled it, and sure enough, it was exactly 100,000 Vega. Pretty clear what was going on there. They were appropriately weighted, and I think we will start to see more of that. Technology makes it possible, and the volatility products educate people so that they will be inclined to try it. And you'll be able to do that in single names. You can do path-dependent dispersion trades. There's a lot of really interesting things that could be accomplished, you know, with some of the technology that's being developed right now.
Obviously, the OTC market is a magnitude greater than the listed market in the option space, but with innovation, we seem to be getting more adherence to the listed space as we create product. And Mark, how are you helping your customers with access to the marketplace?
Well, a lot of what we're trying to do in terms of educating our customers is just to help them understand the dynamics of how to trade effectively. One thing we do, similar to what the SEC talked about, is we record Opera and all the direct feeds and have the ability to run analytics on the data going backwards. Not so much back testing trading, but looking at the effects of latency and the effects of what's going on in the market to a particular kind of application, trying to help them make decisions, and also being able to go back and look at certain situations where things may have gone wrong and just be able to analyze exactly what was going on in the market in that time. And that's helped a lot, I think, in answering these questions of, you know, what's the right strategy, what's the right technology to come together for different customers.
Loren, you're seeing a lot of growth in your product. I mean, OptionsCity is, I would say, it's a relative newcomer compared to that there aren't a lot of market-making application softwares as much as there used to be in the past. You're kind of a relative newcomer in the last 10 years. Hazem has been out there educating as well. Where do you see the growth for your software platform?
I think it's primarily on the algorithmic side. I mean, you know, we see a lot more interest in you know, small trading firms or even you know, local market makers into finding a way to automate some of the trade that they're doing. You know, it's an important part of you know, trading now. I think you know, the automation and algorithmic side of things. You know, and I think that's going to continue to be that way. It doesn't have to be you know, a fully automated kind of scenario, but there's just, you know, various smaller things that even, you know, less sophisticated smaller firms are interested in doing compared to you know, the larger firms of the world. So, you know, I think that's certainly you know, where we're focused on as it relates to growth, and we continue to see more and more interest in that. I mean, you know, I think that translates even further to some of the technological stuff that you see even for available to retail traders now. Not saying that retail traders are going to automate their trade, but you know, various apps and things that you see even for you know, some of the retail brokerage firms and the technology that they're producing. But yeah, I would say, you know, algorithmic trading is you know, where we're seeing a lot of growth.
Do you see a lot of global opportunities?
Absolutely. I mean, you know, we have. I'm missing a meeting today back at the office with you know, a Chinese firm that's looking at you know, our technology and specifically already starting to do some things algorithmically as it relates to the Shanghai exchange. So we've had a lot of interest from Chinese firms about accessing you know, our software to then deploy that you know, in that market. So you know, certainly it's something that's on our radar, and you know, being able to plug into those exchanges is something that we're working on, and we actually have a product that we call the CX adapter that enables you via an API to kind of plug into whatever exchange you care to, as opposed to having to write to it directly and go through that painstaking process. So certainly, yeah, there's an interest globally for sure.
Very good. I want to just I'll throw a jump ball question out there for anyone who's brave enough to answer it. If I gave you unlimited powers to change one thing today to help make our markets better, what would you change? Market structure, rules, regs?
Are those cameras running?
I mean, I guess I could pick something. I think there is a barrier to entry problem in the market right now, and there is, you know, a range of performance you get depending on the technology you can leverage, and you need good performance for certain kinds of applications, and getting that is a barrier to entry. And there's pieces of it, and some of them are getting better quickly. The cost of networking and colo and all that tends not to be the problem. But I will say the trend of exchanges sort of driving up fees on connectivity in order to drive income is having the effect of making it difficult for people to enter the market, and it probably is having an effect on the growth of the market that is counterproductive. It is, you know, it's a very big barrier to entry for new entrants to come into the market and to innovate in the market. Somebody else has to have something.
No.
So.
Well, yeah, I guess where would we? I mean, there's a lot of things I think that we might want to look at. I don't think we need to harp on Reg NMS anymore. I think a lot of people have done that already. But that would certainly be an interesting place to begin. You know, we were in the back, but I heard Blair make an interesting comment about the fact that, you know, when we began in this business, the exchanges were not for profit. And I think this is sort of what you might be talking about. in general, I think for-profit businesses tend to be very innovative, but I don't know that that was a huge problem for us. Certainly not since the ISE came online. In any case, I'm not necessarily suggesting a reversal of that demutualization process, but it has had an interesting set of impacts on what our market structure looks like. Some of them are good. Some of them aren't as good. Maybe I'll leave it at that.
Well, in the remaining time, I'd like to throw it out to the audience. You have some really esteemed experts here in their field. Do you have any questions of any of the panelists on what they see?
I don't have a firm date on that, but I just have 2014. I'm sorry.
Yeah, I don't know if anybody really has a firm date. I've been kind of involved with some Chinese firms for a while. I spent about 3 weeks over there last year, and it kind of seems to be all rumors. The last rumor I heard was June.
I'm hearing the same thing. Around that time frame, it was April, May, and now it should hopefully happen relatively quickly, and that's the information that I'm hearing as well as sometime kind of early mid-spring here.
And as a follow-up, one thing I just heard from Shanghai Exchange was that they're allowing multi-leg orders, but executed individually. Is that true?
I haven't heard that.
I don't know what their structure is going to be.
Yeah. Very possible.
Thank you, guys. Very good conversation. I had a question, I guess, related to education and kind of more specifically advertising. And what you have now is exchanges come up with something proprietary because that's where they make all their money, and they put a lot of resources into some products that don't really get off the ground. I'm not going to pick on anybody specifically, but and then what we see in terms of volume is this really heavy concentration among things like Apple and Twitter and the headline stocks. Do you have any idea or any feeling on kind of what the industry could do to broaden things out a bit? And because you get into this cycle where, well, the markets are crappy and 3,000 listings, so of course it's a terrible customer experience, and the markets are terrible because there's no customers.
Well, I think CNBC and probably to a lesser extent Bloomberg probably bear a little bit of responsibility. These things sort of end up feeding on themselves. If you turn it on and you hear what's going on in the options market on television, they're only going to be talking about those top 20 names, and then of course that's where the volume gets concentrated. So that's what's worth talking about. I think what we're doing as an industry, and I think what you were mentioning before specifically with the registered investment advisors, is trying to encourage them to think about trading these products not because everybody else is, but because of what it might be able to do for their specific returns. I think if we do that with institutions, we're likely to move the needle a little bit more because their trade sizes are larger. So I think liquidity begets liquidity. If we start to see some of them spread out a little bit, then it'll probably draw others into the fold.
And I wouldn't mind adding on to that, if I may. Something that we do that I consider to be probably the most important thing that we do, amongst several things, of course. But I visit a lot of call centers, and I'll talk to a group of 200 people at one crack for like 3 hours in the morning. And I give them ways to not only learn about our products, but how they can actually educate their clients. Because now I've got 200 people working for me. I'm going to teach them how to talk to them. I'm going to teach them how our products work. And now I just leave town, and I've got 200 people that I feel are now promoting not only our products, but our entire industry. So I think that's one of the important things that we do at the CBOE.
I think we have time for one last question.
I have a question on, this has to do with the retail side of trading, and I'm curious if, oh, it's right here, sorry. What is it going to take to break the glass ceiling when it comes to the retail sector. There's a whole slew of generations that come in every 3 to 5 years, and they seem to start off with a speculative attitude on options, and they blow out their accounts quickly. But they haven't really learned the true value of options as hedging instruments. What's it really going to take to increase that knowledge and just get people to understand that, you know, a put is nothing more than their auto insurance policy or their home policy or something like that?
I think that kind of is a nice closing question because it comes to the heart of what this panel is all about. And of course, the obvious answer is education. But as far as how that happens, you know, everybody in this room benefits from the general public understanding options and understanding them well so that they trade them. And I mean, market makers need people to make markets for. Brokers need customers. Exchanges need people trading. And where that growth in general comes from is it comes from the 95% of people who aren't utilizing that resource.
I think the online brokerage community has done a lot in this area. I think, you know, Tom Sosnoff with Thinkorswim and, you know, Interactive Brokers right now is also trying to do a lot to educate. I think Schwab is also. I think that's the touch point for most of the self-directed investment community to our marketplace. And that's likely where they're going to learn the most about it. So I'm pleased to see that they seem to be picking up the reins on that one. And I think they're doing a nice job of it.
Well, I guess we'll have to end it there. How about a nice round of applause for our panelists? Thank you very much.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.